Beloved listeners, dear family of wisdom seekers, there comes a moment in every person's life, a quiet moment of reckoning, when you realize that time is no longer your ally. You've worked 40 years, maybe 50. You've built something, saved something, created a nest egg that represents every sacrifice, every extra shift, every vacation postponed, every dream deferred. And now you face the most terrifying question of your financial life. How do I make this money last without losing it? Because at 60, at 70, you cannot afford to be wrong. There are no do-overs, no second chances, no time to rebuild what's lost. One mistake, one catastrophic loss, and your golden years become years of worry, stress, and dependence. But what if I told you there's a way to protect what you've built while still growing it, safely, steadily, with the kind of certainty that lets you sleep peacefully at night? To let me tell you about a conversation that changed my understanding of everything. I was in my early 30s, ambitious, hungry, taking risks because I had time to recover if things went wrong. I met an older investor, 73 years old, wealthy, comfortable, at peace. And I asked him a question that young people always ask: what's your best investment advice? I expected him to tell me about some brilliant stock pick, some market timing strategy, some secret the wealthy know that ordinary people don't. But instead, he looked at me with these calm, knowing eyes, and he said something I didn't understand until decades later. Young man, the goal isn't to get rich. The goal is to stay rich. I was confused. What's the difference? He smiled. Getting rich requires aggression, taking chances, swinging for the fences. And when you're young, that makes sense. You have time to recover from mistakes. But staying rich, that requires something different. It requires protecting what you have, being boring, avoiding catastrophic losses, because once you have wealth, losing it is the only thing that matters. I didn't fully grasp his wisdom then. But now, after more than 7 decades of investing, after watching countless people build fortunes and lose them, after seeing the devastation that comes from taking unnecessary risks in the final act of life, I understand completely. And today, I'm going to share with you the strategy that's protected my wealth and the wealth of thousands of others through every market crash, every recession, every crisis for generations. Not because it's exciting, not because it'll make you feel like a genius, but because it works every time, without fail, with mathematical certainty. When you're over 60, the game changes completely. The strategies that built your wealth, they're no longer appropriate. You can't afford to lose 50% of your portfolio and wait 10 years for it to recover. You can't afford to chase high returns that come with high risks. You can't afford to be aggressive, bold, speculative. Because time, the investor's greatest asset, is no longer on your side. Let me tell you about a man I knew. We'll call him William. William was 68 when I met him. He'd saved $800 over his lifetime, not wealthy by some standards, but enough to retire comfortably, enough to live with dignity, enough to leave something for his children. But William was worried. His stockbroker kept telling him he needed more growth, that 6-8% returns weren't enough, that he should be more aggressive. You've got 20, 30 years to live, the broker said. You need your money to grow faster than inflation. You should have 80% in stocks, growth stocks, tech companies. That's where the returns are. William was uncomfortable, but he trusted his advisor, so he moved his portfolio from conservative investments to aggressive growth stocks. This was 2007. You know what happened next? The financial crisis hit. The market crashed 57% from peak to trough. William's $800,000 became $400,000. He was 70 years old, half his life savings gone. His broker told him to hold on. It'll come back. The market always comes back. And he was right. Eventually it did come back. But William couldn't wait. His wife needed medical care. His son lost his job and needed help. Life happened. William had to sell at the bottom, locking in catastrophic losses. He ended up with $350,000, less than half of what he started with. The last 15 years of his life, he lived in financial stress, constant worry, unable to help his family the way he wanted, unable to enjoy the retirement he'd earned, all because he listened to advice designed for a 30-year-old when he was 70. To this story, I've seen it repeated hundreds of times. Good people, responsible people, people who did everything right their entire lives, and then, in their final act, They take risks they shouldn't take, not because they're greedy, but because they've been told that conservative investing means accepting poverty, that 6-8% returns aren't enough, that you need to swing for 15, 20, 30% returns to stay ahead. But that's a lie, a dangerous, destructive lie that's destroyed more retirement portfolios than any market crash ever could. Here's the truth. After 60, 6-8% annual returns with safety, with capital preservation, with the ability to sleep at night, that's not just enough, that's extraordinary. Let me show you why. If you're 65 with $500,000 out and you earn 7% per year safely, consistently, in 10 years you have $983,000. In 15 years, $1.38 million. In 20 years, $1.93 million. You've nearly quadrupled your money while taking minimal risk. And here's the critical part. You never had a year where you lost 30, 40, 50% of your capital. You never had to sell at the bottom because you needed money. You never spent a sleepless night wondering if you'd lost everything. You just steadily, boringly, safely grew your wealth. To compare that to someone chasing 15% returns with high-risk investments. Maybe they get 15% for 3 years. They're feeling brilliant. Then the market crashes. They lose 50%. It takes them years to recover. By the time they're back to even, they're 75, and they've wasted a decade. Their average return over that period, maybe 4% lower than the person who just accepted 7% safely, but with infinitely more stress, risk, and sleepless night. This is what most people don't understand about returns after 60. It's not about maximizing gains. It's about minimizing losses. Because losses at this stage of life are catastrophic. If you lose 50% of your portfolio at age 70, you need 100% return just to get back to even. How long does that take? How much risk does that require? And what happens if you need money during that recovery period? You're forced to sell at a loss. Game over. But if you protect your capital, if you earn steady, safe, boring returns, you never face that crisis. You never have that moment of terror. You never lose sleep wondering if you'll run out of money. You just live in peace with certainty. So let me share with you the framework, the exact strategy for protecting capital and growing it safely after 60. This isn't theory. This isn't speculation. This is what I've done. What wealthy investors do, what works. Two twos are the foundation. The ladder strategy, here's what most people get wrong about safe investing. They think safe means putting everything in one place. All in bonds, all in CDs, all in treasury bills. But that's not safe, that's rigid. And a rigidity in an uncertain world creates its own risks. True safety comes from structure, from diversification across time, from what I call the ladder strategy. Here's how it works. You take your capital, let's say $500,000, and you divide it into 5 buckets. Bucket 1, 1 year of living expenses in cash or money market funds, completely liquid, zero risk. This is your security blanket, your peace of mind. The money that lets you sleep at night knowing that no matter what happens in the markets, you can pay your bills for the next year. Bucket 2 years, 2 through 5. In short term, high-quality bonds or CDs. These are paying you interest, safe interest, guaranteed interest, not exciting. Maybe 4 or 5% in today's environment, but certain. This bucket, it's refilling bucket 1 as you spend it every year. You move money from bucket 2 to bucket 1. You're never forced to sell investments at a bad time because you need cash. Bucket 3 years, 6 through 10. In intermediate term bonds and dividend-paying blue chip stocks. Now we're adding a bit more return potential, maybe 6-7% annually, still conservative, still focused on capital preservation, but with slightly more growth to combat inflation. Companies that have paid dividends for 30, 40, 50 years, utilities, consumer staples, healthcare, boring businesses that people need regardless of the economy. Bucket 4 years, 11 through 15. In a balanced portfolio of quality dividend stocks and some growth investments. This is where you're targeting that 7-8% annual return. Still not aggressive, still not speculative, but a bit more exposed to market growth because you don't need this money for over a decade. Bucket 5, everything beyond 15 years. In stocks with higher growth potential and some alternative investments. This is your legacy bucket. Money you probably won't need in your lifetime. Money for your children, your grandchildren, your favorite causes. Here, you can take a bit more risk, because this money has time. This structure, this ladder, it gives you something priceless. It gives you certainty about the next 5 years, while still allowing growth for the long term. You never have to sell stocks in a crash because you need money today. You never have to panic because you have 5 years of expenses already secured. You can let the growth investments grow through market volatility or through corrections, through temporary declines, because you're not dependent on them tomorrow. Let me tell you about a woman who used this strategy. We'll call her Dorothy. Dorothy was 62 when she retired with 600,000. She needed about 40,000 a year to live, plus Social Security gave her 24,000. So she needed her portfolio to provide 16,000 annually, about 2.7% of her capital. Very manageable. She set up her ladder. Bucket 1, 40,000 in a money market fund. Bucket 2, 120,000 CDs and short-term bonds, 3 years of needs. Bucket 3, 150,000 in intermediate bonds and dividend stocks. Bucket 4, the 1,000 in a diversified portfolio of quality dividend payers. Bucket 5, 140,000 in growth stocks and some real estate investment trusts. For the first 5 years, Dorothy lived off buckets 1 and 2. She never once looked at her stock portfolio's value. Didn't matter if the market was up or down. She wasn't selling anything. During that time, the market had a correction, dropped 20%. Her friends panicked, sold locked-in losses. Dorothy. She had 5 years of living expenses secured. She didn't panic. She didn't sell. The market recovered. Her buckets 3, 4, and 5 grew. 2 at year 5, she restructured. Moved some money from bucket 3 to buckets 1 and 2, refilling her near-term security. Moved some money from bucket 4 to bucket 3. Moved some from bucket 5 to bucket 4. And let bucket 5 keep growing. So by age 75, 13 years later, despite spending $16 a year from her portfolio, despite market volatility corrections, even a pandemic, Dorothy's portfolio was worth $840,000. It had grown 40% while she'd been taking income from it. How? Because the structure protected her from panic selling. Because the dividends from her quality stocks kept compounding. Because she earned 6-8% annually on the portions of her portfolio that had time to grow. Safe, steady, boring, but it worked. To the latter strategy gives you structure. It gives you peace. It gives you protection. But structure alone isn't enough. You need to fill those buckets with the right investments. Investments that have proven over decades, over centuries, that they protect capital while generating returns. And that's where most people make fatal mistakes. Because they listen to salespeople instead of studying history. They chase yield instead of understanding risk. They buy what's exciting instead of what's proven. Let me tell you about a man. We'll call him Richard. Richard was 66, had 700,000 saved. Proud of what he'd built. He went to a financial advisor who sold him a conservative income portfolio, high-yield bonds, preferred stocks, master limited partnerships, real estate investment trusts yielding 9, 10, 12%. This is how you generate income in retirement, the advisor said. Much better than boring bonds paying 4%. Richard was thrilled, earning $70,000 a year from his portfolio. That was more than he'd ever made working. For 2 years, the checks came like clockwork. Richard felt like a genius. Then 2020 happened. The pandemic, the crash. Those high-yield investments. They weren't high yield because they were good. They were high yield because they were risky. And when crisis came, they collapsed. Some of his holdings dropped 60%. Others suspended their dividends entirely. One partnership went bankrupt. Richard's 700,000 became 380,000 overnight, and the income he was counting on. It dropped from 70,000 to 18,000. At age 68, he'd lost more than half his wealth and most of his income. He had to go back to work. At 68, because he chased yield instead of understanding risk. This is what I need you to understand. High yield usually means high risk. If something is paying 10% when Treasury bonds pay 4%, that extra 60%, that's not generosity. That's compensation for risk that you at 65 or 70 cannot afford to take. So let me tell you what actually belongs in each bucket. The investments that have protected capital through every crisis, every war, every recession, every market panic. Not because they're exciting, but because they're proven. 2 bucket 1, absolute safety. This is simple. This is not where you try to be clever. Money market funds at major institutions. Vanguard, Fidelity, Schwab. Currently yielding 4 or 5%. Completely liquid. Backed by the highest quality short-term debt or treasury bills. Direct obligations of the U.S. government. Can the U.S. government default? Theoretically, yes. Realistically, if that happens, nothing is safe anyway. Your cash would be worthless. Your gold would be confiscated. So this is as safe gets in the real world. Some people ask about banks. Can I just keep it in my savings account? You can. But make sure it's FDIC insured. And understand that most banks pay almost nothing. Why accept 0.5% when money market funds pay 5%? That difference over a year on a $50,000 is $2,250. Money you're leaving on the table for no reason. 2Oz bucket 2 short-term certainty. This is where you build a ladder of CDs and short-term bonds. Let me explain the CD ladder because it's beautiful in its simplicity. Take $100,000 that you need over the next 4 years. Buy 4 CDs of $25,000 each. One matures in 1 year, one in 3 years, one in 4 years, each paying, in today's environment, somewhere between 5.5% to as each CD matures, you have choices. If you need the money, you take it. No market risk, no uncertainty, it's there. If you don't need it yet, you roll it into a new 4-year CD at the back of the ladder. This way, you always have money coming available and you're always earning interest. No market risk, no price fluctuation. Perfect certainty. For the bond portion of bucket 2, short-term treasury bonds, 1 to 5 year maturities, or short-term investment grade corporate bonds from companies like Microsoft, Johnson & Johnson, Berkshire Hathaway. Not junk bonds, not high-yield bonds, investment grade only. Yes, they pay less. That's why they're safe. You're not trying to get rich in bucket 2. You're trying to preserve capital and earn modest, certain returns. 2's bucket 3, income with safety. Now we start adding stocks, but not just any stocks. I'm talking about the dividend aristocrats. Companies that have increased their dividends every single year for 25 years or more. Think about what that means. These companies raised their dividends through the 2000 crash, through 9/11, through the 2008 financial crisis, through COVID. Every year, no matter what, they found a way to pay shareholders more. Let me give you examples. Procter & Gamble. 67 consecutive years of dividend increases. They make soap, toothpaste, diapers, cleaning products. Things people buy in good times and bad. When the economy crashes, people still brush their teeth, still do laundry, still buy toilet paper. P&G sells products with pricing power. When costs go up, they raise prices. Their dividend yield today is around 2.5%. Not exciting. But they've increased that dividend an average of 5-7% per year. So if you buy today, in 10 years your yield on cost is 5%. In 20 years it's 10%. And the stock price typically appreciates too. Because as dividends grow, so does value. 2 Johnson & Johnson. 61 consecutive years of dividend increases. Healthcare, medical devices, baby products. People get sick in recessions. Babies need diapers in depressions. Essential, reliable, boring. Currently yielding about 3%, growing 5-6% annually. 2 Coca-Cola, 61 consecutive years of dividend increases. People drink Coke when they're rich. People drink Coke when they're poor. Global brand. Incredible pricing power. Fortress balance sheet, yielding about 3%, growing steadily. 2 these companies and dozens like them, they form the foundation of bucket 3. You're not buying them to double your money next year. You're buying them because they're going to pay you reliably and increase that payment year after year after year. And over 15, 20, 25 years, those growing dividends and share price appreciation deliver 6-8% annual returns, with far less risk than chasing high-flying tech stocks or speculative ventures. I also add some bond funds to bucket 3, intermediate-term treasury funds, or investment-grade corporate bond funds. These provide ballast. When stocks have a bad year, bonds usually hold steady or even gain. This balanced 60% dividend aristocrats, 40% quality bonds in bucket 3. It smooths out the ride, reduces volatility, helps you sleep to us as bucket 4, quality growth with income. Now we can be slightly more aggressive, because this is money you won't need for a decade or more. Here, I look for quality companies with strong competitive advantages, reasonable valuations, and the potential for both dividend growth and price appreciation. Not speculation, not hoping. Quality. Let me give you my criteria. The company must have a competitive moat, something that protects it from competition, brand loyalty, network effects, scale advantages, regulatory barriers, high switching costs, something that means competitors can't easily steal their customers. The company must generate strong free cash flow, not just revenue, not just accounting profits. Real cash, money that comes in the door and stays. Because cash is what pays dividends. Cash is what funds growth. Cash is what survives recessions. The company must have reasonable debt levels. I want to see debt-to-equity ratios below 50%, preferably below 30%. Because when crisis comes, and it always comes, debt kills companies. The companies that survive and thrive they're the ones that didn't over-leverage in good times. And the company must have a history of shareholder-friendly capital allocation. Are they buying back shares intelligently? Not at peak prices, but opportunistically. Are they paying dividends and growing them? Are they making smart acquisitions? Or empire building? Waste management matters. Capital allocation matters. A mediocre business with excellent management beats an excellent business with mediocre management. 2 examples from bucket 4 might include Visa, not a bank, a payment network. Every time someone swipes a Visa card, Visa gets a tiny fee. No credit risk, no inventory, almost pure profit, growing dividends. Buying back shares, dominant market position, currently yielding less than 1%, but growing so fast that yield on cost quickly becomes substantial. Home Depot, dominant position in home improvement, massive scale advantages, loyalty programs, professionals depend on them. Yielding about 2.5%, growing steadily, will benefit from housing trends for decades. 2 Abbott Laboratories, medical devices, diagnostics, nutrition, healthcare demand growing as population ages, pricing power, global reach, yielding over 2% strong growth, steady performer through all conditions. 2 I might have 20, 30 companies like this in bucket 4. Diversified across industries, across business models, across geographies. So if one sector struggles or others compensate, no single investment is more than 5% of the bucket. If something goes to zero, which is unlikely with quality companies, I lose 5%, not catastrophic, not life-changing. Just an unfortunate loss in a diversified portfolio. To 2's bucket 5 legacy and growth, this is money I'm probably never going to touch. Money that will compound for 20, 30 years before my heirs receive it. Here, I can take more risk. Because this money has time. But even here, I'm not speculating. I'm not buying cryptocurrencies or penny stocks or whatever's hot. I'm buying growth businesses with strong fundamentals. That might be volatile, but of enormous long-term potential. 2 technology companies with competitive moats. Think Microsoft, Apple, Alphabet. These companies are generating tens of billions in free cash flow annually. They're returning money to shareholders through buybacks. Yes, they're expensive. Yes, they're volatile. But over 20 years, they're probably going to be fine. 2 real estate investment trusts that own essential property types. Cell phone towers, data centers, industrial warehouses. As the world becomes more digital, these assets become more valuable. They pay dividends, they grow. They're tangible. Some international exposure, because America isn't the only place creating wealth, but carefully. Developed markets, quality companies, not emerging market speculation. I might put 5-10% in something truly alternative. Maybe some commodities exposure through funds. Maybe some preferred stocks from rock-solid companies. Maybe treasury inflation protected securities to hedge inflation. Small positions, diversifiers, risk reducers in different ways. But here's what I never do in any bucket. I never buy anything I don't understand. I never buy anything without a clear thesis for why it will create value. I never buy anything just because someone told me it's a good idea. And I never, ever buy anything that promises returns that seem too good to be true, because they always are. Let me tell you about the power of this approach over time. I know a couple, we'll call them Henry and Louise. They retired at 65 with $650,000. They set up the 5-bucket structure. They filled each bucket with exactly the investments I just described. That was in 2010. For the first 5 years, they lived off buckets 1 and 2, never sold a stock, never panicked during volatility. Their dividend stocks in buckets 3, 4, and 5 just kept paying dividends. Those dividends automatically reinvested, buying more shares. In 2015, they restructured the buckets, moved some appreciated stocks from bucket 3 to buckets 1 and 2, refilled their near-term security, but they never sold everything, never tried to time the market. just systematically, boringly moved money from longer-term buckets to shorter-term buckets as needed. Intel's in 2018, a market correction, down 20%. Their friends panicked, sold stocks, went to cash. Henry and Louise, they had 5 years of expenses secured. They didn't need to sell anything, so they didn't. The market recovered in 2019. They benefited from the full recovery. In 2020, a COVID crash, down 35% in a month. Again, they had years of expenses secured. Again, they didn't panic. Again, they benefited from the recovery. By 2024, 14 years after retiring, despite taking $30,000 a year from their portfolio, despite market crashes, corrections, volatility, Henry and Louise's portfolio was worth $1.1 million. It had grown 69% while they'd been living off it. So how? Because they averaged 6.8% annual returns. Not by taking huge risks, not by timing the market, but by owning quality businesses that paid growing dividends. By never panicking and selling at the bottom. By having a structure that removed emotion from their decisions. Their average return was less than the stock market's long-term average of 10%, but they experienced far less volatility, far less stress. And they never had a year where they lost 30, 40, 50% of their capital. Safe, steady, boring, and after 14 years, they had significantly more wealth than when they retired. This is what 6-8% annual returns compounded over time with capital preservation can do. It's not exciting. It won't make for great cocktail party stories. But it works. And at 60, 70, 80 years old, works is all that matters. So you know what's destroyed more retirement portfolios than market crashes? Not bad luck, not economic catastrophes, not even poor investment choices. It's the investor themselves, their fear, their greed, their inability to stick to a plan when emotions run high. I've watched people with perfect strategies, perfect portfolios, perfect structures, destroy everything because they couldn't control themselves. Let me tell you about two investors. Both started retirement with $700,000. Both used the exact same bucket strategy. Both owned the exact same investments. One ended retirement at 90 with $2.3 million. The other ended at 90 with $340,000. Same starting point, same strategy, completely different outcomes. What was the difference? Discipline. The first investor, we'll call him George, he set up his buckets. He bought his investments. And then he left them alone. When the market crashed in 2008, his friends were panicking. His neighbors were selling. George looked at his buckets. He had 5 years of living expenses secured. He didn't need to sell stocks, so he didn't. He went fishing instead. When Bitcoin exploded in 2017, when everyone was getting rich overnight, when his nephew was bragging about 500% returns, George looked at his buckets. He was earning 7% annually. His dividends were growing. His capital was safe. He didn't chase Bitcoin. He went fishing instead. When COVID crashed the market in 2020 and all, when the news was screaming about the end of the world, when the market dropped 35% in weeks, George looked at his buckets. He still had years of expenses secured. He didn't panic. He went fishing instead. Are you seeing the pattern? To the second investor, we'll call him Walter, he had the same structure, but he couldn't leave it alone. In 2008, he panicked. He sold half his stocks when the market was down 40%. I'll buy back in when things stabilize, he said. But stabilized, kept feeling like maybe it'll go lower. By the time he felt comfortable buying again, the market had recovered 60% from the bottom. He bought back at higher prices than he'd sold at. He locked in losses and missed the recovery. In 2011, he heard about gold. The dollar is collapsing. Gold is going to $5,000 an ounce. He sold some of his Dividend Aristocrats and bought gold at $100 per ounce. Gold promptly dropped to $1,200. He held it for years. It barely moved. Meanwhile, those Dividend stocks he sold, they doubled. In 2017, the Bitcoin, he couldn't resist. He took $50,000 from his safe investments and bought Bitcoin at $18,000. It crashed. He sold at $6,000, lost $35,000 every few years. A new mistake, a new panic, a new chase. Always reacting. Always thinking he was being smart. By age 90, he'd turned $700,000 into $340,000, half gone, because he couldn't sit still. George the fisherman turned $700,000 into $2.3 million, not because he was smarter, not because he picked better investments, because he understood something profound. In investing, especially after 60, doing nothing is usually the right answer. There's the psychological traps. Let me tell you about the mental traps that destroy retirement portfolios. because knowing these, understanding them, being able to recognize them in yourself, that's more valuable than any investment strategy I could give you. 2's trap 1. Recency bias. This is the belief that whatever happened recently will continue happening. The market's been going up for 3 years. It'll keep going up. Better get more aggressive. The market crashed last year. It's going to crash again. Better go to cash. This trap, it makes you buy high and sell low. The exact opposite of what you should do. 2. I watched a man in 2009, after the market had crashed 50%. Sell everything. The market is broken. It's never coming back. I'm going to cash. He missed the entire recovery, the greatest bull market in modern history, because he extrapolated the recent past into the infinite future. 2. The antidote to recency bias. Remember that markets are cyclical. What goes down usually comes back up. What goes up usually corrects. And your bucket structure protects you from needing to care about short-term movements. You have years of expenses secured. Let the market do what it does. Trap 2. Loss aversion. We feel losses about twice as intensely as we feel gains. Losing $10 and hurts more than gaining $10 and feels good. This asymmetry, it makes us do irrational things. We hold losing investments too long, hoping they'll come back. So we don't have to accept the loss. We sell winning investments too soon, afraid they'll turn into losses, so we can lock in the gain. 2. I knew a woman who bought a stock at a 40E. It dropped to 25. She held it. I'm not selling until it gets back to 40. I'm not taking a loss. Meanwhile, that 2025 could have been invested in something better, something growing. 10 years later, the stock was still at 28. She'd wasted a decade waiting to break even. The antidote: think in portfolios, not individual investments. Some stocks will go down, that's fine. Others will go up. What matters is the total, the portfolio return. Don't get emotionally attached to individual positions. 2's trap 3. Overconfidence. This is particularly dangerous for men. I say that as a man. We tend to overestimate our ability to predict the market, pick winners, time moves. Study after study shows that men trade more frequently than women and earn lower returns as a result. Because every trade costs money, and most trades are based on overconfidence, not insight. 2. I knew a man who'd been successful in business, smart, accomplished, used to making good decisions. He was convinced he could pick individual stocks better than the market. For 10 years, he traded actively, picked his own stocks, moved in and out based on his analysis. His return, 3.2% annually. The market returned 9% during that period. He underperformed by nearly 6% per year because he was too confident in his own abilities. 2. At the antidote, humility. The understanding that you're competing against professionals with better information, better tools, and more time. You don't need to beat them. You just need to join them by owning the whole market through index funds, or own the highest quality businesses that have proven themselves over decades. Trap 4, anchoring. This is when you fixate on a particular number. I won't sell until it gets back to what I paid. It was 100 last year, so 80 must be a bargain. I need to make 50,000 this year, so I'll take more risk to hit that target. These anchors, they're arbitrary. The market doesn't care what you paid. The market doesn't care what you need. I watched a retiree in 2000 who'd built a 1.2 million portfolio. The tech bubble burst. His portfolio dropped to 800,000. He should have been fine. He only needed 40,000 a year. That was 5% of 800,000, but he was anchored to 1.2 million. That's my money. I need to get it back. So he took bigger risks, bought more volatile stocks, tried to recover faster, and he lost another 200,000. By the time he accepted reality, he had 600,000 left, half of what he'd had, all because he couldn't let go of an arbitrary number. The antidote: focus on what you need, not what you had or what you want. If you have 500,000, you need 25,000 a year to live comfortably. That's a 5% withdrawal rate, totally manageable with a 6-8% return. It doesn't matter if you used to have 700,000. That's gone. Focus on what's real now. Trap 5, hurting. Humans are social creatures. We feel safe doing what everyone else is doing. When everyone's buying stocks, we want to buy stocks. When everyone's selling, we want to sell. This creates bubbles on the way up and crashes on the way down. In 1999, everyone was buying tech stocks. You're going to miss out. The old economy is dead. People who'd never invested suddenly felt stupid for not owning pets. In 2006, everyone was buying real estate. Prices only go up. Get in now or be priced out forever. People with no business buying investment properties were buying 3, 4, 5 properties. In 2017, everyone was buying Bitcoin. The future of money? You don't understand the technology. People were mortgaging their homes to buy cryptocurrency. All hurting. All ended in tears. To the antidote. Be comfortable being different. Be comfortable missing out on the party. Because when everyone's at the party, that's usually when you should leave. The best investments, they're the ones nobody wants. The ones everyone thinks are boring. 2's trap 6 action bias. This is the belief that doing something, anything, is better than doing nothing. The market's volatile, better make some changes. Returns were flat this year. Better switch strategies. Your neighbor made money doing X. Better try X too. But in investing, action usually destroys value. Every trade has costs, commissions, spreads, taxes. Every change creates new risks, new uncertainties, new chances to be wrong. 2, I knew an investor who checked his portfolio every day, and every day he found something to worry about. This stock is down 3%. Fat stock is up 5%. Maybe I should take profits. The market dropped 1%. Maybe I should reduce my exposure. Constant action, constant trading, constant change. His returns terrible because he paid away his gains in costs and taxes. The antidote. Benign neglect. Set up your structure. Choose quality investments. Then leave them alone. Check once a quarter. Rebalance once a year. Otherwise, go live your life, the discipline framework. So how do you avoid these traps? How do you maintain discipline when your emotions are screaming at you to do something? Let me give you a framework. A set of rules that, if you follow them, will protect you from yourself. Rule 1, never make investment decisions when emotional dodge. If you're scared, wait. If you're excited, wait. If you're angry about losses, wait. Give yourself 72 hours. Write down what you're feeling and what you want to do. Then after 3 days, when the emotion has passed, look at what you wrote. Does it still make sense? Usually it won't, is rule 2. Have a written investment plan by C, not in your head. Written down. What's your bucket structure? What percentage in each bucket? What specific investments? What are your rebalancing rules? When will you move money between buckets? Under what circumstances will you sell an investment? Write it all down. Sign it. Date it. Then, when you're tempted to deviate, read your plan. Ask yourself, am I being smarter than I was when I wrote this? Or am I just being emotional? Usually, you're being emotional. As rule 3, automate everything you can. Automatic deposits from checking to investment accounts. Automatic dividend reinvestment. Automatic rebalancing once a year. The less you have to decide, the fewer chances you have to make emotional mistakes. 2's rule 4, limit your information intake. 6, stop checking your portfolio every day. Stop watching financial news. It's designed to make you anxious, so you keep watching. Stop reading market predictions. Nobody knows what's going to happen next week, next month, next year. Check your portfolio once a quarter. Read your statements. Make sure everything's on track. That's it. The rest is noise. Dangerous emotion triggering noise. 5th rule 5, have an accountability partner. C, tell someone you trust about your plan. A spouse, a friend, an advisor you respect, someone who will ask you, does this align with your plan? Someone who will remind you of your goals when you're tempted to chase performance or panic during volatility. You don't need their permission, but you need their perspective. 2 rule 6, remember your why. Why are you investing? What's the goal? It's not to beat the market. It's not to impress anyone. It's not to feel smart. It's to maintain your standard of living, to preserve your independence, to protect your dignity, to not be a burden to your children, to leave something behind, to live with peace. When you're tempted to take unnecessary risks, remember your why. Is chasing an extra 2% return worth risking your peace, your independence, your legacy? No, it's not. Let me tell you about the most successful investor I ever knew personally. Not the richest, not the one with the highest returns, but the most successful because he achieved exactly what he wanted. His name was Edward. He retired at 67 with 850 Zalodern. Not wealthy, but enough. He set up his buckets. He chose quality investments. He wrote down his plan. And then for the next 28 years, he barely changed anything. He lived through the 2008 crash, didn't sell. He lived through the European debt crisis, didn't panic. He lived through Brexit. through trade wars, through COVID, through everything. And he never, not once, violated his plan. When he died at 95, his portfolio was worth $2.8 million. He'd taken $35 in a year out of it for 28 years, nearly $1 million total. And still, it had more than tripled. How? Discipline, consistency, patience. 6.9% average annual return. Nothing spectacular, but compounded over 28 years with no panic selling, no chasing returns, no costly mistakes. It produced extraordinary wealth. His children asked me to speak at his funeral, and I told them what Edward had told me years before. Getting rich is about being smart. Staying rich is about being disciplined. And dying rich is about being patient. That was his philosophy. That was his life. And it worked. So let me ask you, are you willing to be disciplined? Are you willing to be patient? Are you willing to do nothing when everything in you wants to do something? Are you willing to be boring when everyone around you is being exciting? Are you willing to miss the party to avoid the hangover? Because if you can set up your buckets, choose quality investments, write your plan, and stick to it, you will preserve your capital. You will grow it safely. You will sleep peacefully. And 20, 30 years from now, your children will look at what you built, what you preserved, what you passed on, and they'll understand you weren't being conservative. You were being wise. You weren't being timid. You were being disciplined. You weren't missing out. You were winning the only game that matters, the game of sleeping peacefully, living with dignity, and leaving a legacy.